Security analysis, some of y'all, this is your second semester, most of y'all, Andrew's new. I can't, Gerardo, Jacob, there's a few, August, but mostly Jose, so most of y'all were here last semester. So we have a live portfolio, it's about 2.65 million right now. It's doing well. I have it set up. You just see the Excel spreadsheet set up that does a really good job of keeping track of the portfolio. We have 26 stocks, I think. We need to have 30 by March 1st. We're 70 something percent in ETFs. We have to be below 60% by March, which means I need some buys before the end of March. So the way this class will work, it'd be somewhat different than last semester because we're going to move a lot faster. Last semester, we had some introductory stuff to do that we won't need this time. Those that haven't had the class before, you'll have plenty of videos that will help you get there and get what you need. And I'm always there. We're in here with 20 people. I'd rather meet in the FSC. The FSC has exactly, guess how many seats? 20 seats. Last semester we had 25, so we couldn't have done that. 20 people in a room that hosts 20 is a bit crowded, so we'll have to see. Do y'all want to try it next Tuesday in FSC and see? Y'all know where the FSC is? Downstairs, 1.104. We'll see. You won't all have access to Bloomberg, but we can share somewhat. So the idea is that we meet in FSC every Tuesday, and then Thursday is individual work. But it's not goof off time, so I want to see. I will be taking attendance on the days you're supposed to work. It doesn't have to be Thursdays, so if you'd rather have a different time, coordinate it with me. I want to be there though and see what you're working on. So I want it to be rigorous. Obviously, you're going to be spending a whole lot more time than just Thursday working on your projects, but I do want to see you there. So we will meet as a class on Thursday. So this week will be the only time we'll meet on Thursday as a class. So what that means is I need to see you sometime during the week outside of class for at least 30 minutes or so. If you don't want to do the Thursday at 6 o'clock, then set up another time with me. I'm really free Tuesdays and Thursdays from like 2 to 5:30. Monday and Wednesdays I'm somewhat free, but we're doing our dashboard teams on Monday, Wednesdays from like 2 to 4, so don't have as much time. So y'all coordinate with me. What we want to do is get a process. I'll show you the process. I'm scared to ask the team from last semester to actually remember any of the process. Anybody remember step 1, step 2, step 3? Anybody? What was step 1? Industry analysis. Industry analysis. Well, even before that, step 0. What do you think we're going to be doing next week? Screening. Got to have a screening model. You have to have a universe screening model. Then the industry analysis, and then what? Company analysis. So I'll see how much of that you remember. So we do have a process. I want to see you walking through that. We learned a lot last semester, so it'll make it work a lot better this semester. The pitches were really strong last semester with 2 major weaknesses that we'll talk about, one on the financial analysis side, one on the relative value side that you really need to add for it to make it a strong one. I was noticing it with the judges because I could tell from their questions, like, where's your relative value analysis? I don't see it. So there's some things we need to add that need to be put in there. Bloomberg does a pretty good job with that. But essentially, last semester worked really, really well. I do want to do a better job of recording on this semester. So I need your approval to put it out there on YouTube. So I'll have something you can sign. If you don't want to be out on YouTube, then you just won't have it. The reason that's important is the idea of teams. So last semester you had teams. We had to do a presentation in the team. There's no team presentations this time. So don't think about it as teams. Think of it instead as a committee to vote. So you will be in groups of 3 where you're going to vote on which stocks that were pitched you want to actually put into the portfolio. We did that, remember last semester, those that were there, we did it with the first round where y'all got together and voted. We ran out of time the rest of the semester. So teams to vote, what does that mean? If you're in a team, your requirement on your team is pretty easy. You've got to watch the stock pitches of your team members, and then you'll have to get together and vote, right? So that's a lot easier than last semester. So we have to figure out the teams. Let me show you a little bit of the portfolio. So here's our portfolio right now. This is from inception, September 2nd through today. We've added 71 basis points in return. What do you like? Oh, sorry, Andrew. I had to sell Netflix because it fell more than 15% relative. We got another one that's close. I forget which one. Well, it was Kroger's, but I guess it's coming back today. But yeah, so we sold it. Since then, it's kind of gone sideways, but I had to sell it. That's no bad reflection. We said the Warner Brothers deal could cause some problems, and we decided to go for it. So it wasn't entirely, unexpected that it could have gone either way. So we're beating our stocks that we have picked have added 71 basis points, and that's just in 4 months. So that's pretty October, November, December. Yeah, in 4 months. I was looking at UTS Austin, they're below the index, so we're beating them, although I think a lot of it is noise. Interesting, only half of our stocks are beating their indices, their indexes, their sectors. But the ones that are beating by a lot. So we've got 3 that are just really zooming. Who did Rambus?
Sebastian.
Sebastian. So yeah, Rambus just recently just shot up. I don't even see it. There it is.
You should tell
Yeah, it's beating its index by 17%. ACMR is beating us by 56%. Dollar General was our number 1 stock, and it's gone a little bit sideways since, but beating by 20. So the ones that are beating by a bunch. Those are. Here's one. Oh, Abercrombie. We may have to sell that one because it hits the 15%. So our idea is you buy a stock and it underperforms this sector by 15% or more. Obviously, we made some mistake. We're just going to get out. Your ego will usually say you're so worried about regret that you get out and then it shoots back up. And it's just, there's a lot of studies showing that's a really bad way to trade. So this is our existing portfolio doing pretty well. 70 basis points in 4 months, that's pretty strong. For the month of January, here's our portfolio. Here you can see Abercrombie is really sold off. It's 15% since inception, so the fact that January has had a bad month is not that much. You can see ACMR, really all of its outperformance happened just in January, whereas Dollar General, this is since purchase, and you can see that this is the alpha just for the month. So for the month of January alone, we added 34 basis points for the stock picks. So it's doing well. I think that's 20. Well, I guess we have 30. Well, we have 29 stocks now, but 29 stocks. So we're close to having the 30 that we need. And then the overall portfolio, including the ETFs, through today, we're flat. We're at 5 basis points and the stock market's down 0.66. So our return since inception is 7.4. The stock market's up 6.4. Forget what our benchmark is. I don't know if it's 100 basis points or 200, something crazy. What percentage of managers beat the S&P by 200 basis points? It's less than 5%. So it's a pretty high order to ask us to do that. Our beta, the last time I calculated, is 0.99. So very much in line. Our market cap, something I was really worried about because y'all are buying some really small stocks like Green Brick. But our market cap is 37 billion and the S&P is 40 billion. So we're only slightly smaller than the S&P. So our beta is a little bit on the low beta side, but not much. And our market cap's a little, I don't mind being a little small cap right now because what a small cap done the last few weeks, it's crushed large cap. So it wouldn't be so bad. I don't mind being a little bit low beta, especially in a day like today, but it's not material. Our sector allocations are practically right in line. I think our worst is off by 0.25%. So 25 basis points. We're really close on the sectors. So I'm watching that pretty closely. Now, are you worried about a stock that's up 50 something percent in just a few days? So something we're going to be starting with the investment society that you can be involved as you like. But every Wednesday, there's people in the investment society who wants to learn our valuation model. So every Wednesday, we're going to pick one of our stocks and we're going to spend an hour valuing the stock that you recommended. And if we see a stock, I mean, is it possible ACMR was a great buy in December, but now that it's up 50%, maybe it's, I don't remember what your target price was, but maybe we should be selling. So that's what the investment society students will do every Wednesday. If you want to participate in that, just come by at 2 o'clock on Wednesday. We're going to pick a stock and value it. We won't sell it without telling you, but we might say, wow, we just looked at Dollar General and man, it looks a little rich to us. We think we're ready to sell it. It's up 30% since we bought it. And you can say, wait, no, you're using the wrong numbers or whatever. So it gives them a chance to participate and get some involvement. So that's a good way for us to we may be able to get 2 or 3 stocks done on Wednesday. So we'll see on that. So the class, you have 3 things to do, 3 pitch books to do, stock pitches. So round 1, 2, and 3, all individual. You present for 10 minutes, you get 10 minutes of Q&A. Y'all saw that somewhat last semester, same process. We'll do it on Zoom and live. There are some incentives. We have 2 outside presentations set up. We're going to do Frost April 2nd. We're going to need some volunteers, or if we have too many volunteers, Dr. Katavakum and I will decide based on how well round 1 went. We haven't decided that'll be what do y'all think? Do y'all like them being competitions or not? Yes. You prefer it that way? Yeah, yes. All right. So Olivier is thinking about setting up. I don't know if we have cash prizes or not. We'll see. I am working on the Victory Capital one, which would happen in May, of having a pretty significant cash prize for that one. We'll see. What was it last time? Like $100? It's like not very much. 500 for the winner. Oh, is it 500? Yeah, for second place. I think Carson got like $100. All right, so I'm trying to beat that up quite a bit. We'll see if we can get more into that. I kind of wish Victory had something to it, but if not, we'll find a donor related to the class to help push it up some. So round 1 will be probably at the conference center at Frost Bank, so we'll have to drive down and do that. We can have 5 people do that. And then Victory Capital, 5 people. Victory Capital, they tried to get local news to show up and they had them, and then something came up the last second. So that's one you could actually be on the local news doing your presentation. We'll see how that goes. You do the stock pitch. So the way the process works, we'll go through the entire process and get some practice. And I'll show you the spreadsheets I've created. I've really worked on the valuation spreadsheet. It's all in one big model. The financial analysis spreadsheet is going to need some work, and you'll see why, because you can't use what we did last semester to do banks and insurance companies. But the format is there. We just have to make some edits. So what are we going to do? Or any questions up to there? You see what you're going to do? 3 stock pitches. How easy can that be? Three presentations and you're done. And how long does it take to build 1 stock pitch? Can't be more than 60, 70 hours, right? It's pretty straightforward. So we got to figure out which industries you're going to do. Which industry did we do last semester? We did tech. The weight probably. Yeah. So information tech, what else do we do? Communication services. What else? Industrials. Storage tables at the bottom. That's it, right? So what do we have left? So what we need to decide tonight and Thursday, which is the reason we're meeting here, is really, really important. Where are you going to work? So there's If you do financials, let's talk financials. That's my area of expertise. So if we do financials, I have to say three people on financials. So what is financial? Y'all know the main breaks on financials?
Banking, insurance,
So banking, insurance, and they break up, they talk capital markets. So I have to think through that. So we'll have one of you doing banking, but your team will be banking, insurance, and capital markets. And so when you recommend that you want to buy JP Morgan, I say that's what you're going to do. Your team of three are going to have to vote whether you really want to put JP Morgan into the portfolio. Everybody understand that? So you'll make your JP Morgan presentation and your team's got to watch it and then you'll vote. So we have a committee structure of some kind. I get the ultimate veto on everything. They just give me all the power. I'm kind of the portfolio manager. We have a committee structure supporting that. How large does the stock need to be to get into the portfolio? At least $1 billion, right? So financials. So if we look at financials, you got financial services, banks, and insurance. What is financial services? Capital markets, financial services, consumer finance. Now, if you do banks, how would you break banks up into it? So what we're going to be working on this week and next week is the screening model. The way I do banks, if I were doing banks, I would do large banks, small regional banks, and fintech. I'd probably break it up like that. Now, fintech may not be in financial services. It may be in tech. So how would you find the major fintech? I would probably go on Google and say, list the major fintech businesses. Who is the biggest fintech? Probably JP Morgan, right? They're doing fintech, but how would you break that up? So you'd have to figure out how to do that. Capital markets is radically different than banking. So we'll have to figure out how we're going to break that up. So someone will probably do financial services. There are some in capital markets that belong in banks. Sometimes they'll put JP Morgan, they'll put Morgan Stanley and Goldman Sachs under capital markets. Why? Because they have a big investment portfolio. So State Street's a good example. What is State Street? Sounds like a bank, doesn't it? But State Street's not a bank. It's really a custodian bank and it's an investment firm. What does State Street do that you buy all the time? Yeah, which one? What's their ETF? Spiders, right? You've seen the spider lifting weights. So State Street, we use State Street a lot, but it's a custodian. You don't call up State Street to do a swap for you or to do an M&A deal for you. They're a custodial bank and they do investing. So they're probably going to be under capital markets. Northern Trust, have y'all heard of them? Big bank on the East Coast, North Carolina bank. But you probably don't think of them as a bank. They're custodial, they do investing, so they're a lot like State Street. So capital markets is very, very different. How does BlackRock make money? It's management fee times assets under management, right? Pretty straightforward. If the stock market goes up 10%, guess what happens to their revenues? They go up 10%. Very high beta business. But that's not JP Morgan. What does JP Morgan do? They borrow money from the depositors, they lend it out to their autos and home, make a spread. There's a lot of interest rate risk. Very, very different businesses. So on banks, on financial services, I'm proposing financial services, which are these type of entities, the investment side, banks, and insurance. Now, how does insurance break up? What are the two major, I didn't say three, I used to do three, but what are the two major insurance? P&C and life. What's the third one that used to be in this category? Health. Where did health go? Under health. They actually put the insurers for health, and it's gotten a little confusing because what does Allstate sell? Are they P&C or are they life? The answer is yes, they are. Can you analyze a life insurance company the same way you analyze a property casualty company? No, they're radically different businesses. One's a spread business. The other one is well, you'll see when we talk about the loss ratios and expense ratios. So it gets a little tough. Those are tough industries. They're tough to analyze, and it gets even tougher when they're doing multiple things. Allstate's tough because the life side and P&C side, they're so different. It's really hard to combine them together. Some firms like Chubb, it's all P&C, a lot more straightforward. What about State Farm? Who's going to analyze State Farm? Nobody. Why? They're not publicly traded. So how do you handle when the largest auto insurer is not publicly traded? Can you get something from the internet to show their market share versus your company? When you want the largest player in the business to have their revenues on your market share, if State Farm's 25% of the market, Allstate's 10%, would you want all State Farm in your analysis? So insurance is tough because there's a large portion of the insurance industry that is not publicly traded. So you see the issues you're having. This is not easy stuff. Fortunately for you, this is my area of expertise, and my best friend works at Victory Capital. It's also his area of expertise. I know I can persuade him to come talk to you all, so we can have some expertise there. I know banking fairly well. So talking about banking, the last semester we used firms like gross margin, net margins. Do banks have gross and net margins? No, not really. What kind of margin do they have? The net interest margin, that's really, really important. Banks, you'll notice with Bloomberg, they won't even give you an EBITDA for a bank. Why is that? Because you do before interest for a bank. For a bank, interest is part of their operations. It's not the side of how they fund their operations. It's actually operations. They're borrowing money from their customers and lending it to their customers. So EBITDA doesn't make sense. Free cash flow doesn't make sense for a bank. So you can see we're going to have to make some adjustments. I was listening to CFI, Corporate Finance Institute, their FMBA. It was interesting what they said about banks. They did a pretty good job. They said you don't use free cash flow for a bank. You use dividends. You just can't use. There's really nothing like a free cash flow for a bank. Well, insurance is somewhat similar to that, but not exactly the same. You also don't, well, do y'all know what the efficiency ratio is for a bank? Have y'all heard that? You want it to be higher or lower? What would be good? You want a bank whose efficiency ratio is getting higher or getting lower? Lower, yeah, that's their expense ratio, right? Do you want a high expense ratio or low expense ratio? So you gotta know these ratios. We're not going to do debt to equity. What would you do for a bank? Starts with a T. Tier 1 capital, your capital ratios. You look at your capital ratios. So why am I saying all that? Let's say you pick banks. What's the first thing you're going to do after class? You can go on to YouTube, financial analysis of a bank. You can get the bank's annual report. You can see what ratios they're showing. You can see on the financial analysis, I tried setting up the bank, but it still needs some work. You're going to need to change a lot of the ratios. You're not going to do gross margins. You're not going to do net margins. You're going to do other things, expense ratios. What about loan to deposit ratios? You want that higher or lower? You can tell what it is, right? It's the amount you have loaned out divided by deposits. Frost Bank has one of the lowest ones in the industry. Is that good or is that bad? What happens when you have a low loan to deposit? It means you have a lot of capacity for growth. You can lend out a lot. You haven't loaned out your entire book of business. And Frost Bank has always been talked of as a really good takeover candidate. Can you imagine Goldman Sachs, who needs all these deposits because they went from an investment bank to a commercial bank? Wouldn't it be wonderful if they could just buy Frost Bank and get all those deposits and have this loan book? So those are kind of ratios you're looking for. We go into YouTube and we do financial analysis of banks. Not every one of them will be good, but you can kind of tell, look and see how professional, look at the source and see. I mentioned Corporate Finance Institute. What I've seen from them on analysis of banks is really good. A lot of the stuff is free on YouTube. So you might just go into their site and see what they have. Yeah, some of these are on the other side. This is not analysis of, that is CFI there. They're talking about how banks do financial analysis, but you're analyzing the bank, all right? So you have to make sure you get a good one, but there's plenty of them out there. What would happen if you went to ChatGPT and say, what are the key ratios? Someone should try it on your phone. What's the key ratios to look at when analyzing a bank? See what comes up. What is the bank's revenue? So what revenue, what's the main sources? Well, there's usually three of them. What's the most obvious one? Loan interest, right? They loan out money. What's the second really important one? Fees, like overdraft fees. And then what's the third one? That might be high at Goldman and Morgan, but not high at Frost. What do Goldman and Morgan do that Frost Bank doesn't do a lot of? But what is all that trading revenue, that investment banking revenue? So you want to bring, when you bring revenue in, you want to see those three components. You have a bank that has high trading. I mean, think about some years, there's years where banks' income is up dramatically because they have a lot of trading revenue. What's that going to do on the other side? It can go to zero. So you have to be real careful. That creates a lot of volatility. So this is what, if once you pick your industry, I'm not saying, oh, are you going to do banks? Once you pick your industry, you really want to go on YouTube and say, what are those ratios I need? And then I'll sit down with you with the financial analysis and help you. And you remember our two sources for data? Bloomberg and Capital IQ. So we'll look at Bloomberg Capital IQ. I was surprised. I forget which one it was. It may have been net interest margin or the efficiency ratio. One of those two Capital IQ didn't have. I had to get it from Bloomberg. So we had to jump back and forth. But so you see why it's so important we pick your industry as soon as possible, because you need to go out there and see. So banking and insurance, I can handle that. I know P&C and life on the insurance side really well. They're really very different businesses. But I don't know energy sector that well, but we have people who do want to talk to you on the energy sector. I know Michael Lee has volunteered, even though he's a brand new baby girl, so he may not be as willing as he was last year, but I think he'll help. Andrew, who was in this class several years ago, he's on the energy side, energy and utility side as well. We have a few in Houston that are in the industry, energy industry, that we'd be willing to talk to you. So we need to get that decided and try to set you up so you can talk to them as early as possible. We have Valero right next door. There's some people there that can certainly talk to us, not just on refining, but probably even broader, just in the whole energy side. So our goal this week is to get you selected on the industry. So financials will probably break up capital markets, banks, and insurance. Which of those is the hardest, do you think? Insurance. Insurance is really difficult. I'm tempted to flip real estate into financials and not have it as a separate category, because I'm not sure. We definitely can't have a team on real estate, so we'll probably make real estate part of financials, and just make it part of the capital markets. Real estate used to be part of financials, and they kicked them out, and it's now one of the smallest sectors out there. Real estate, what do you do? It's real estate and operating companies and real estate investment press, REITs. It's those two groups. Then you get the utilities. Utilities are tough. I hate utilities. When I was an analyst, I was supposed to analyze utilities, and the guy who was to train me, it was really fun getting trained. He said, "Here's my training." He walked over with a sack of books, put them on the desk, and says, "Okay, I just finished training you," and he walked away. He wasn't as bad as the tech guy. The tech guy said, you can think I'm exaggerating. I do exaggerate, but not on this one. This is actually a legitimately true story. He said, "You can have lunch with me. You can talk to me for 1 hour. After that, I don't want you to talk to me again." And that was my training on technology. He's a real arrogant guy. So anyway, and that's what I was asking questions, writing. He says, "Your hour's up." I said, "Okay, never talk to you." That's how I got trained on utilities and technology. Utilities are tough. We do have some really good people high up in utilities that can certainly help us. You can see here on utilities, electric, independent, multi-utilities, gas, water utilities. Each one of them have their own thing. And the really difficult thing on utilities was the deregulation that went on about 15, 20 years ago. It has just made it really complex. And then you have alternatives. How are you going to handle alternatives? So you're going to look at, the solar companies. Are they part of this group? Are they under industrials? So you have to kind of look through that. Paul did waste management, right? Waste management used to be a utility. Now it's under industrials. I think of it more as a utility. It feels more like a utility to me, but it's moved over to industrials. So just because S&P classifies, like me, fintech classifies fintech as tech, you can move it in the financial analysis, financial services if you like. Um, so that's utilities, healthcare. I have two healthcare people who want to talk to us. One's working for United, well, actually, two of them work for United Health. He was explaining United Health to me. I thought, man, that is a complicated company. United Health has firewalls set up because they're in businesses they shouldn't be in, and to try to prove that they're not rigging the system. They're supposed to be operating as independent businesses, but obviously getting sued and by the federal government. There's obviously some disagreement on how well they're doing that. Pretty tough. How would you break up healthcare, pharmaceuticals, biotech? Tough industry. I don't know if it's as tough as insurance, but pretty tough industry. How do you analyze a pharmaceutical? So if you do a pharmaceutical, what do you think the first thing you do in a pharmaceutical is? List all the drugs and their revenues, when it got its patent, when does it go off patent, what are its new drugs coming out, what is its R&D? How do you forecast a drug they're not even started on yet? They haven't spent any money on it yet. How do you do that? Do you assume some return on R&D? How's R&D accounted for? So it gets tough. And then you break up healthcare. Where did I put it? Oh, I don't know where I put it. But equipment and services, I thought I brought that one over. But equipment and services, healthcare's equipment is actually one of the easier ones. That one's not too tough to do. That one almost feels like an industrial. They're making stuff they sell to hospitals. And then services. Services as well, where the health insurance comes in. But health insurance, Allstate used to do health insurance. There's other companies that did property and casualty, health, and life. A lot of life insurance companies did health insurance, but that has all been consolidated. And you have firms like Humana and United Health, these massive firms that really are dominating the health insurance side. So it gets tough. Services includes hospitals, the health includes the health insurance. Where would you put Walgreens? Is that consumer staples or is that healthcare? How much of your spending at Walgreens is healthcare versus retail? What about CVS? Are they different? So you might find one of them is listed under with Walmart and one of them is listed as a pharmaceutical. Why is that? What does CVS do that is so different than Walmart? And Walmart, I'm not Walmart, I'm sorry, Walgreens, excuse me, Walgreens. Yeah, every time I do Walgreens and Walmart, I mix them up. So Walgreens is more retail and a consumer staples, and CVS is more healthcare, but you can certainly debate those two. So healthcare services so we'll probably break it up, pharmaceuticals, equipment and services, and then services will have the insurance piece of it. A lot of the insurance part of healthcare is not publicly traded. A lot of these Blue Cross Blue Shield types that are just these kind of professional organizations, you can't actually get the numbers, so it gets a little tough. But there are certainly some health insurers that are pretty enormous. That's healthcare. Now, for those that are new to the class, and if you're scared to death, we have one industry that's not too tough. We carried this over from the spring and the fall semester, materials. Materials is by far the easiest one on this list. So if you're like, man, I don't know if I can do this, start with materials, and you would have an excuse because you didn't take the first semester. So you can start with something a little more straightforward. How would you break up materials? Where did I put it? So chemicals, metals, and then others. Chemicals, metals, and everything else. Everything else might be paper companies, lumber companies, those type of things. Where do you think some lumber companies are sitting though? Do you think they're sitting on the materials? How would you structure yourself if you're a lumber company? If you want a really good tax treatment, structure yourself as a REIT. So if you have a lumber company that's structured as a REIT, would you move them to materials or would you leave them in their real estate? I would probably put them under materials. Have you heard of American Towers? What is American Towers? They have all this land for these towers for your cell phone, but where are they classified? They're a REIT. Do you think of American Towers as a real estate company? Sounds a little more techy than that, right? So there's places where it gets a little bit tricky. But yeah, pretty straightforward, chemicals, metals, and everything else. So materials is probably, a nice thing about materials is all the Excel files we used last semester work perfectly well for materials. You don't need to make any adjustments. And then energy, how would you break up energy? So oil, gas, consumables, energy equipment and services. Energy equipment and services is probably the more straightforward one. Looks more like an industrial. That one's pretty straightforward. But then you get into the energy side, the oil, gas, consumable. Typically, what do you think? Upstream, midstream, and downstream. And I always get those confused, but so what is Valero? Is it upstream or downstream? I always get them. You can see I'm not an energy person. So I know it's at the end. I just don't know if the end starts on the downside or I guess it would be downstream, right? Because you start up there and you float down. So what is Exxon? It's everything. Does everything. So how do you compare those? Valero says they're the largest, but they compete. Exxon is as large as they are in a lot of ways on the refining side. So and so that's the integrated. You got the Chevrons, the Exxons, those type of companies. We're doing the S&P 500. What might you do? Aubin did this with the airlines. What might you do with energy on the integrated? So what stock do we buy for you? Ryanair. Does that sound like an S&P 500 stock? So would you do British Petroleum? Would you bring in some of these others? So some of them aren't publicly traded, right? So there's some pretty large players that aren't publicly traded. So we can find a break this up, and we do have some expertise that can help you with this. There are some places where you're looking at miles of pipeline, your proven reserves, those type of things that you look at how much you're producing. Valero is pretty interesting in that they're more into these alternative fuels. They're trying to find some way. What happens when people stop driving cars? What are they going to do? And how material is that? Pretty interesting. You got someone right up the street. I was thinking about having the energy people present once at Valero. I don't know if we can do that if we're doing refineries, because I don't want to go to Valero and you don't recommend Valero. You might not be well received, so there may be some biases there, but I think they're going to know Exxon and Chevron and all the others. So you probably could do an integrated firm there. The problem with these categories is there's firms that are in 2 or 3 of these categories, and it just gets tough when you're trying to analyze them. Did I leave any? So here's the real estate. It's just real estate investment companies and REITs. Really not too much. So anyone have a problem with us growing real estate in with financials, or someone here like, I really want to do real estate? So I was going to throw real estate in with whoever does capital markets would do real estate. So we have 20 students, and we have 1, 2, 3, 4, 5. Let's see how good you are at math. How many does that put on each committee? 4 people. It sounds like it, right? So we got 20 people in 5 sections. So we're gonna have to figure out how to break up this group. So your goal is, so if you think about the process, let me bring up the process from last semester, since I'm sure y'all still have it memorized, right? So if you're going to do an industry analysis, what's the most obvious thing to put in ChatGPT for that? Fortis 5 forces. You've probably had that in other classes. ChatGPT does a good job. Where else can you go? So AI, what was the other one we did? Remember from the library? IBIS. So Do you need a report analysis? This is the industry analysis. These are the big questions you got to make sure you address in your presentation. You don't necessarily need to build one, but you want to read one, get a Porter's analysis, read through it. What are the issues? Can y'all name them all? The 5 forces are firepower. So you need to talk about the customer. Who is the customer? Is it the military? Are they the middleman between the business and the consumer? Are they producing the raw material? Obviously, if you're doing chemicals, you may be, the production side selling to someone else. Biopower, what's the next one? Threats of new entrants. So how protected is your industry? These industries we're doing are pretty well protected, most of them, because these are pretty high capital equipment. What's the third one? Supplier powers. So that includes labor. Remember, you got to talk about labor issues. If you're doing metals, who is doing metals? Yeah, so a major strike in South Africa is huge for these companies. So yeah, the labor side, and then raw materials. It can be things like the cloud. What cloud services are they using for Netflix? You really need to understand the services you're getting from Amazon or those kind of things. So supplier power, what was the next one? Substitutes. Substitutes, not always an issue for a lot of industries, but it might be. What's the threat of substitutes for oil? We might as well electricity or electric cars, whatever that may be in there. That's some of them pretty obvious. And the last one, if you're worried about threats to new entrants, what are you worried about after they've already entered? Rivalry between them. How does rivalry come out? Rivalry comes out with a lot of consolidation, margins getting compressed. You have a lot of people fighting over. The worst thing is to have people fighting over market share on a market that's not growing. That's essentially mature. You could think in terms of the life cycle. So remember demotorin, and just where is your industry in the life cycle? Is this early? Is it growth, mature, declining? Where is your industry? So you might think refiners might be declining if you think we're going to be driving a lot of electric cars. Demotorin's life cycle video is really, really good. How should a firm that's a growth firm be managed differently than a firm that's mature or declining? So there's some stuff that you can do there. Then you can do screening. I will help you build your screening model. And we need to really get that done this week and next week. So that's pretty critical. We build the screening model. We have some already built, but we got to reconfigure them. So how are you gonna do this? You need to go out and you really need to understand what are those key ratios. So for banking, net interest margin, efficiency ratio, tier 1 capital, return on assets, what are those key ratios that people look at in your industry so we can screen on those? I'm going to do screening model a little differently this time. I've been trying to experiment 2 different ways. Remember last time we let the model decide on our weights so we get our R squared as high as possible. This time I want to actually let the R squared get really low, and we're going to decide what we think is important and just say, hey, wow, this firm's ranked number 1 and it's the 87th most expensive. Sounds kind of interesting to me versus having the model run so it becomes number 3 and it's the 4th most. It's like, wow, I must have a good model. You can do it both ways. We'll do it both ways. We'll just see, what is to me, the high R squared tells you what our investors focused in on. It makes you a little nervous that if you're focused on X and you're looking at Y, that makes you nervous. But if you really believe expanding margins is critical for your business and the market says that's not important, then let's leave what you think is important there. So we'll do it a little bit differently now. Y'all remember doing screening models last semester? We did them pretty fast. So, and then get the company analysis. What can you look up here on AI? Value chain analysis. Who created value chain analysis? Y'all remember that guy's name? We've already mentioned his name once before. Porter again, right? Porter all over again. Porter's pretty impressive. So you can go into ChatGPT and do a value chain analysis for your firm. Pretty important. If you haven't had value chain analysis, Wikipedia does a pretty good job. of summarizing it. And in SWOT analysis, you can do a SWOT analysis just in ChatGPT. IBIS does that as well. Investec, some of the others. So you're really trying to figure out. So at a step 2, you're going to have a buy list. You probably want to have 8 to 10 stocks on your buy list. You don't want your buy list to be 3, because now you're going to do all this other work, and you got 3 stocks, you got to do 3 pitches. You may end up with 3 stocks you don't like any of them. You'd be recommending sells on all 3. Really hard for me as a portfolio manager to get up to 60 something stocks if all you do is give me sell recommendations. So that doesn't help. So we need buy recommendations. Does that mean you have to give me 3 buy recommendations? Well, if you look at 10 stocks, you only get 2 buys out of that, then you'll do 2 buys and 1 hold, or 2 buys and 1 sell. You're not gonna force it. Maybe like ACMR, maybe Luke, in November, wow, I really love this stock, but maybe he did it today, it would be a hold. And so, I mean, it's up a bunch in 1 month, right? If you start off and it's trading at $40, you recommend a buy, and you look, and now it's trading at $65. Could that possibly change your recommendation? Definitely could. So as part of the problem we have is you start in January and you're making your pitch in May. It's a good chance a lot of stuff has happened and you'll change your opinion. So you want to try to get 8 to 10. It's going to be kind of tough to get 8 to 10 on some of your industries. We'll see how many there are to play with. And we may have to do a little bit of editing to get that. And we may find on big banks we can't do it. Maybe one person is going to focus on big banks, and then 6 of these small banks, and the other one's going to do these 9 small banks. You have to do something like that. So that's what we're going to see. We have to kind of play it here as we go. Y'all remember our universe? Russell 3000 plus some non-US stocks that we throw in, like on the energy side, we'll probably throw in. Healthcare, we probably won't throw in too many non-US stocks, but on energy, we probably will. Utilities, probably won't be a lot of non-US stocks on utilities, but that can help get our list up a little longer. So value chain analysis, what you're really looking for is that economic moat. I forget the other guy, the 7 powers. His name starts with. Is that Helmer? There he is. I read the book. Do any of y'all use Helmer? So if y'all listen to The Acquired, that podcast, they go Helmer at the end every time. I've read the book. I didn't find it that impressive, but its overlap with Porter's is pretty high. It's overlap with value chain management. I prefer value chain management, but if you want to use Helmer's 7 powers, you certainly could. Just give you another approach. But economic mode, another word for that is sustainable competitive advantage. If you have a sustainable competitive advantage, you should have margins that are higher, consistently higher than your competition. You're getting paid more and getting to keep it, getting higher revenues. So you should have higher returns on capital, higher EVA, higher margin. Above average margins, above average return on invested capital, above average EVA. Pretty key that you can, in a 2 or 3 sentences, explain what is really special about your firm. That's the key thing that you can say that, wow, this is what separates them from everybody else. And then you do financial analysis. We will use this same approach of short-term volatility and long-term viability, long-term growth, liquidity, solvency, turnover margins. It's just going to look really different in some of these industries. We'll have to pick very, very different ratios. I mean, like with the bank, the efficiency ratio is under margins, except for instead of looking at how much you make divided by revenue, you're just looking at how much your expenses are relative to your interest income. So it's a very similar type of ratio. For insurance companies, you have expense ratios. And P&C side, y'all know the ratio for that? y'all heard of this before? Anybody heard of the combined ratio? Anybody took my P&C class? I'm teaching it. Anybody taking it this semester? So yeah, we'll talk in my P&C class. We'll talk about combined ratios. Those that went to the Blackstone interview, I was pushing all that information to them, even though it was more on the life side. The life insurance side looks a little bit more like the banking side, but it's definitely different. But so there's the ratios are different, but the categories are the same. So turnover is really bizarre for banks and insurance companies. Really, really strange. We have to think about it differently. The key with, say, life insurance company or let's say property casualty company, they're very, very careful about separating the investment side from the underwriting side. You have investment income, you have underwriting income. The combined ratio is only the underwriting side. So you separate that. You would never add the investment income in with the underwriting premiums. Very, very different businesses. So turnover is a little tough. I did a ROE decomposition for USAA. I wanted to compare to competitors, and you should have seen it. I actually had some additions in there because you had to separate the investment from the insurance piece. You can't combine those two. We had a new CEO at USAA who came from the banking side, and he wanted to treat the investments as his money, and the insurance was the insurance company's money. And I had to inform him that the regulators don't let you do that. The regulators view the investment side as needs to go back to the customer. You may know what is Warren Buffett called this on the insurance side? You may know his term. Float. So what is float? So if you buy auto insurance from Geico, Warren Buffett considers you a cheap source of capital. You can give him $1,000 in premiums, and on average, he'll pay back $950. So essentially, he's borrowed money from you at -5%. Kind of unusual business, right? You would never say it on the life insurance side, but on the property casualty side, you would. So the categories are the same, but the ratios are going to be very, very different. So keep this template. Don't forget the template. Short-term viability. You'll probably focus quite a bit on that, on like on the bank of the tier 1 capital, their credit ratings, those type of things, just to make sure this isn't an entity about to go under. And then turnover margin, it's going to be kind of interesting. And a good example, let's just give you an example. Let's take Valero. So Valero, look at their turnover. You look at their revenue, say, to their property, plant, and equipment. You say, wow, it's really up this year. Well, why is it up this year? Well, because oil prices are up, gasoline prices are up. Did they really have great turnover that year, or is just their prices are up? So let's think about that. What is their revenue is gasoline. Is there ever a time where gasoline prices shoot up 40% where oil prices didn't move at all? You think that's ever happened? There's a high correlation, right? Can Valero say, you know what, oil prices are down, we're buying oil at $50 a barrel. Let's increase our gasoline prices 40%. Is that ever going to happen? It's not going to happen, right? The competition is going to bring them down. So gasoline is up, but so are oil prices. What is oil prices for Valero? That's their cost of goods sold. So if I'm looking at turnover for Valero, I'm probably not going to use revenue. What might I use instead of revenues? I'm not going to do revenue, the property, plant, and equipment. Can you think of what would be a better one to use? If I do that, I'm just, their revenues are up because gasoline prices are up, but their spread's not as good. What could I substitute? Gross margin. Exactly. Anybody know what this gross margin is called? Sounds like a drug addict. Crack spread. What is the crack spread? It's how much they're making on the gasoline over what they had to pay for the oil. So if I'm doing Valero, I'm going to look at a turnover. Well, I don't want to look at the revenue because that's just going to tell me that gasoline and oil prices are up. I want to look at that net that they're getting over the gasoline. Unfortunately, you have that crack spread. Now, I don't know if you can get that for the company individually, you can certainly look up crack spread and see it from the industry level, whether you can get that specifically for Valero. So hopefully we'll find someone in that business that can show that to you. All right, so the point is the outline works, but the ratios don't. You got to make some adjustments to the ratios, except for materials. Y'all can just keep using what we've been doing. All right, and then you got valuation, which we now have a model for valuation. Will it work like it did last semester? Well, loss or minnows, maybe most of it will. I'm liking that spreadsheet. I'm getting it fancier and fancier. Try to connect it all together. Does beta work the same for a bank as it does for, I mean, is it exactly the same or is it different? It's pretty similar, all right? So you don't have too much. What's your big challenge? Remember how we adjusted beta for debt to equity or the debt? For banks, that gets a little tricky because, you know, think about a bank. Most of their debt comes from whom? Their customers. And think about it from a bank standpoint. You know, Frost is paying you what, 0.2% on your savings account? How many of y'all would loan money to Frost at 0.2% with no FDIC insurance? Any of y'all do that? So Frost can borrow money really, really cheaply because we as taxpayers are backing them up. That's pretty nice, isn't it? You don't want them borrowing money. You want them getting deposits. Y'all see, you know, when Silicon Valley went under, y'all see those CD rates from JP Morgan and Bank of America. They're paying CD rates of 0.1%. Why were they doing that? Because people were desperate to park their money somewhere, and they're borrowing money 5 years at 0.1%. Would any of y'all like to do that? Like a mortgage at 0.1%? So they had this huge advantage in that they had the federal government is keeping their cost of debt really, really low. So it does create some strange analysis. So these three models will essentially work with one big problem we're going to have with banks. I need to adjust the model. So you remember what relative value banks and insurance companies use? You got price to earnings, you have EV to sales, and price to book. Which of those three you think you can use? For banks and insurance companies, always price to book. But remember, the investment banking model is not set up for price to book. So I got to figure out some way to set up that model. What I'm thinking about maybe doing is bringing in return on equity and using that as a way to back into the book value of the firm so we can do a price to book, but I haven't quite figured that out. I'll have to look at it. But we'll be doing screening models before we will need that. So you can do the same three models with some adjustments, not radical adjustments. Remember, banks, we won't use free cash flow, we use dividends with some adjustments and not radical adjustments. And then the football chart at the end that we've gotten used to. Where do we need to beef it up? The two areas that were the weakest last semester were the financial analysis and the relative value analysis. Those are the two. We need to talk more about that. We need much more of that. Some of y'all showed almost no financial analysis. Some of y'all talked about it, like their margins have been improving. You didn't show any chart on that at all. There's stuff like that. You need to be bringing some financial analysis into the presentation. Relative value, which mainly my fault, and we're out of time here, mainly my fault. You definitely got to show their current, like if you're doing banks, their current price to book. I mean, you look at Citibank. I have to show you on Thursday. Citibank's price to book is still so low. They're still trading below 1, whereas JP Morgan's jumped up to 1.5 or something. You really want to look. Citibank looks really cheap. Now, why do they look cheap? There's some good reasons for it, but you want to compare your company to those main competitors on that relative value analysis. And a lot of y'all didn't do that. So it's hard to see, is it trading rich or cheap? You talk about it rich or cheap to its history, which is what the football chart does, but are they rich or cheap to the industry? We need to do a lot more of that. And then you come down with your final recommendation. So what are y'all going to do between now and Thursday? We're meeting here on Thursday. Go find those ratios. 2 ways to do it. YouTube, financial analysis of a property casualty insurance company. Number 2, bring up Allstate and see what ratios they're putting in your annual report. All right, can y'all do that between now and Thursday? Start getting working on it. All right, we'll stop it there. Any questions? Those that are, this is your first time this semester, you're probably like, my word, he just starts, but second
What was
semester.
the billion in reference to again?
Yeah, the market cap needs to be at least $1 billion just to buy it. So the first part of the semester, which gets a little bit tough because we're about, we're a month, I mean, think about it, we're 1 month away from your first stock pitch, which is not that much time. Next week is incredibly important. We've got to run your screening models because you need to next week know which companies on your list. So tonight, let's talk through the process. So if you're in an interview and talking about doing a stock portfolio, running a stock portfolio, what would you actually do? So I'll do it for you tonight, and I'll be quizzing you on this every once in a while throughout. But the first thing you do is industry analysis. This is where you bring the porters in. What are you going to do with your stock pitch on this? Porters is something you want to think about. Usually you can bring porters in on your SWOT for your company, especially opportunities and threats. So do a porters, read a porters. You don't have to actually write one. Just go get one and read it and highlight what are those key issues in this industry that you want to make sure you're hitting. For banking, it's all about recessions and interest rates. For life insurance companies, it's all about interest rates. For property and casualty, it's about regulatory powers and about accident rates and catastrophes and those kind of things. So each industry has certain things you want to really cover. I have a really good article from The Economist talking about data centers and the utilities industry, talking about here's an industry with all this wonderful growth. Unfortunately, they don't have the production capacity to meet the growth demands. I had another Economist article on another industry, and I can't remember which industry it was, but it was an interesting article. So when I'm riding my bike, listening to these articles, The Economist does a really good job. If any of you want to sit down with me with my Economist subscription and just type in your company or your industry, some good articles come up. They do a good job of summarizing. But start with the porters, the 5 forces, use AI. You can definitely use IBIS World. There's good places to get a good porter analysis. Then we're going to do next week, we're going to do screening models. I'm going to talk about that tonight. Your goal is to try to get all the companies in your industry down to a buy list, and the buy list for you probably needs to be 8 to 10. So, and with the valuation model we have, you can do a pretty quick valuation on those 8 to 10 companies to try to get the one you want to really start with first. But that's going to be critical. Then you're going to do your company analysis. You're going to start off with uniqueness. This is really so critical when you're making a presentation. What is it about this firm that's different from everybody else? You need to start off with that. This can be the concept of the value chain management. That you can put in AI. AI does an amazing job on value chain management. Another Porter model, really good. You can look at things like economic moat. I gave you Helmer's if you wanted to do that. 7 powers. Sustainable, competitive, advantage. And then there's specialized issues like brand value. Those kind of things that you're looking for. So Luke told me about the Coca-Cola on Acquired. I haven't been on Acquired in a while. I listened to it. It was interesting what they said about brand value. Remember, we said brand value usually comes in with higher margins. With brand value, you can charge more, so you have higher margins. But they say with Coca-Cola, Coca-Cola has brand value, but they don't get any extra margin for it. They don't charge any more than Pepsi or Dr. Pepper or anybody else. So where does the brand value come in? And it was interesting what they said about with New Coke and Classic Coke. Brand value came in with people saying, no, Coca-Cola is an American icon. It's not going away. People are like, no, we want our Coca-Cola. I don't like it. I don't like drinking it, but you better have Coca-Cola available. It was an interesting twist on the brand value discussion. But those are the kind of things you're looking for extremely important that you make that distinction up front. There are industries that it's really tough to do. When I was at USAA in the 90s, banking, it was impossible to tell one bank from another bank. There was way too many of them. We'd had 6 or 7 banks come in a day, and at the end of the day, we're thinking which one we'd like the best, and we can't remember which one was which. A bunch of people in blue suits and red ties and white shirts, and it's like, yeah, why would we hire? And we'd ask each one of them, why should we hire you and not your competitors? And it was a fruit salad of making up stuff that made no sense. So spend some time here. What is it that's really key? But there are some models out there that really help you with that. Then you're going to do financial analysis. We're going to talk quite a bit on this because that financial analysis is going to be key to our screening model. So we talk about liquidity, solvency, turnover margin, return on capital, those type of things are going to be really important. You want to bring a lot of those into your pitch book. Then you have valuation. We typically use discounted cash flow, relative value, and then we're going to use the traditional investment banking model. So valuation, and we summarize it all up with a football chart. Then you have your recommendation. You might have an appendix, your presentation. So the weaknesses last semester on the presentations of financial analysis, you really need a lot more financial history on your company, margins or revenue or something, especially compared to competitors. I set up a spreadsheet for you that does a lot of that for you. As we get into it, those that didn't have the class last semester, I can do it. Gerardo looked a lot like we did in business finance. It's that similar type of spreadsheet where you're comparing yourself against the industry. So if you didn't have class last semester, I can certainly help you on that part of it. We got to get your stocks first that you're going to work on so we know which ones to plug in there. And then on valuation, on relative value, you really need to do more on that. You need to be looking at your firm's relative value versus key competitors versus their history. You need to show that as a chart. That's pretty important. So DCF, investment banking. Are there other models? Yeah, there's others that are out there, but these are the key ones that you'll see the third one in a whole lot. Dr. Wald, his problem with our presentations was the DCF. I agree with him. I think the valuation is the most important thing that you're doing. But I know in most stock pitches and competitions, students present their valuations and they get very few questions about it. So what you really need to be for Dr. Wald's standpoint is at least in your appendix have the details on it. What were your growth rates? What were discount rates? What was your free cash flow starting point? How did you get those growth rates? Those kind of things. You need to be ready to show that, even though it probably will not come up in a question. I can't remember on the CFA Research Challenge. I can't remember judges ever being picky about valuations. They tend just assume all the discussion before somehow magically got into the valuations correctly. If you listen to the Motoron, he does ask pretty sharp questions about valuation, especially on growth rates, pretty critical. So from Dr. Wald's standpoint, that's his biggest problem with the presentations he saw last time. Is just like they don't show us how they got their values. How can I assess if it's a good presentation or not? But that could be a good backup. So there were a few areas last time that were a bit of an issue. When you do your actual pitch book, what's the first thing you say in the first 3 minutes? I remember.
Thesis.
Your thesis, right up front. So I'm recommending a buy on this stock because that's the first thing you say. All right. Initiating coverage of XYZ company. I'm recommending a strong buy on this company because of their unique ability to blank, blank, blank. And I don't think the stock market is has fully recognized the power of this particular model or whatever. You start off with that. Most of y'all did that last semester. Some of y'all forgot, got kind of deep in before you go. So you start off with that thesis. Some of y'all do this. Reed, you do this really well. You should maybe share yours of having it actually you show your thesis up front and then you work the thesis in detail. I don't know if that's a model you've seen before. It works really well, right? So in your intro, you say, I got my three theses. One is based on this, one on this, one on this, based on that. I have a strong buy. And then you work through those with data that supports it. That just makes it really clear to the audience exactly what you're proposing and why. And it also gives them a way to ask questions. Okay, why do you think that's so unique? Or why do you think the market hasn't recognized that? How are you going to do that? I want y'all to know this off the top of your head, so you just naturally go into it. I have a more detailed one that I will put out there on Canvas, but essentially that's the process. It seems pretty simple. It's pretty straightforward. The hard work is especially in that uniqueness part. We've set up a spreadsheet that does most of the middle section, the financial analysis and evaluation. We have spreadsheets that do that for you. So we've got a lot of that taken care of in advance. Here's the brand valued firms. I don't know if any of y'all used this last time, but you do have some places you can go to see, does this firm have some special unique recognition value that separates them. This semester, it's a little bit different because we're not doing the consumer side, so that may not be as valuable. Questions on that? Those who haven't had the class before, we'll have to show you some example pitch books so you can get comfortable. Maybe we can show you some from last semester, some practice. All right, so let's talk. So y'all should be working on this right now. Learning your industry from a porter standpoint. What are those key issues? One thing you might think about is economic factors. So, if you're doing chemicals, where are you sourcing those chemicals from? How's your labor issues? If you're doing healthcare, it's regulation, it's the Affordable Care Act, it's yeah, a lot of it's just government, what's going on in government. Obviously, right now, Congress has been debating the Medicare and updating Medicare and Medicaid and those type of things. If you're doing, well, we talked insurance. Insurance is interest rates on the life side and just regulation and catastrophe risk. What are our other industries? We only have 4, right? Materials. Utilities and energy, obviously it's commodity prices. Well, on materials, obviously you're seeing what copper hitting some pretty massive rises. The gold hit another record this week. We're getting some crazy numbers on platinum. You're definitely seeing on the metal side some interesting times. Utilities and energy, obviously utilities, it's the data centers and what's going on there. It's capacity. Energy side, it's it's the move to EVs. It's getting more efficient. It's what's going on in Venezuela and Iran, and there's a lot to think through. So read through those issues, do some Porter analysis. But the Porter analysis should include the economic factors. So keep those in mind. Look at labor issues. Think in terms of life cycle. There's a lot of things you can do this weekend. The other thing to think about is the annual report of largest companies. We'll talk about this more when we talk about screening. There's a few things there you want to do. Every firm in the annual report has the business description. Business description is not just specific to the business, it's also an industry type of analysis. So pick one of the biggest players. Get United Health. I can't imagine United Health's business section. It's probably almost unreadable, pretty complex. Get Eli Lilly and read through it. Get Exxon, get Valero. Just pick a few of the big players in the industry and just get that business section and read it. And then also look through for charts for key ratios that they're showing that may not be normal to you. And you can go to, let's see if it's still out there, Exxon has done this in the past. So if you go to the investment relations section, they will often have PowerPoints, investor presentation. They will also often have PowerPoints that are really, really quite powerful, really, really good. So here's ExxonMobil's. That's going to give you some ideas of the kind of things you should be looking at. You might say, well, that's really biased, right? This is Exxon, but they're not. They know their investors. They can't make this, too simplistic and too watered down. It's got to be significant for their investors. So have y'all tried the investor relations sections of some of your key companies just to see what they have out there? And you might be amazed they have some really good stuff. And you can sometimes even copy their charts that they're doing, they're showing. So, that's quite a bit of information, right? That's pretty impressive. Now, can you just take one of these charts and use it in your pitch book? Yeah, just say, hey, looking at Exxon's investor relations, they had this really interesting chart that I decided to use. I mean, that's fine. Just don't use it without telling them that you got it from Exxon. But really, really good stuff. Not everybody does this. I don't know about Valero. Investors, events and presentations. So they have something. Not everybody will, but a lot of them will. Let's try one more. JP Morgan, investor relations. Yeah, there's some good stuff out here of investor conferences. I wish we could do a trip to an investment conference. They're really, really, really good. I love listening to the CEOs of companies talk. To me, it's the most insightful. As the CEO is so critical to a firm. So I wish we could watch some of these, but yeah, the investment conference presentations are really, really helpful. So they have some stuff out there, their earnings presentations. So there may be some stuff out there. One other thing we talked about in prior classes that could be pretty valuable. I can't tell which model I have where. And that is YouTube. YouTube either on financial analysis of the industry or interview of a CEO. Those are helpful. So it doesn't have like Jamie Dimon. It's hard to get an interview of him talking about JP Morgan. He's talking about the economy or the president or something. But if you can find an interview of a key CEO, like the CEO of Exxon, the CEO of whatever, a lot of times those can be really, really insightful. So between now and next week, when we start the screening, get your mind into this industry and start thinking about those topics. So you start getting the jargon, get some comfort when a lot of those key ratios they keep coming up. I'm not sure listening to earnings calls would help. Maybe. I don't know, those are kind of boring, but that might give you some insights on what's going on. But this weekend, really get focused on this so that Tuesday and Thursday of next week, Tuesday will be in the FSC. We're going to really be working on a screening model on Tuesday, maybe Tuesday, Wednesday, and Thursday. So if some of y'all can come in on Wednesday, we can try to get these models done. We really want to, think about if next Thursday, if you don't have your stocks, then we're talking about giving you 2 weeks to do your stock pitch. That we're really running out of time. So we really need to know your stocks next week, especially the newer students in the class. We're going to have to spend more time with me one-on-one to make sure we get you everything we had from last semester. So we really need to hit the ground running next week. So hopefully no one's out sick. Some of y'all are being sick, so don't get sick next week. All right. Wash your hands, walk around. One thing I learned from Alexei in Costa Rica is it's not washing your hands that's important as the friction. Friction's the most important thing. That you can just do that a lot, and it's almost as valuable as soap and water. So just every time you shake someone's hand, just start doing this, and it's actually the friction that's important. All right, let's talk about screening models. So I want to use a slightly different model this time, and I want you to think tonight through what we're going to use. So the screening model is going to be qualities we desire in a stock versus valuation. So we wanted to find a good stock with our screening, and we're going to compare that, a good company, sorry, we're going to define a good company with our screening and compare that to valuation. If we think exactly like the market thinks, then our favorite company is going to be the most expensive company. And our least favorite companies can be the cheapest company. If that's the case, then there's no opportunities. We all agree with each other. It's like nothing to do. So what we could do is think about these qualities. What are the qualities? Well, it's the same thing as a financial analysis. So it's liquidity, solvency, turnover, margin, and return on capital. Those are the categories we're going to use. For liquidity, our main focus there is working capital. But banks don't have working capital, insurance companies don't have working capital. So for them, it's going to be a little bit different. Solvency, we might look at their debt to equity, their debt to EBITDA, their credit ratings, which is kind of tough because that's a letter, not a number. But I like, y'all know, I like the default, the Bloomberg default. So they have something called the probability of default. Works really, really well. It does have a high correlation with ratings, so that works well. I'm not sure they do that for banks. We'll have to look and see. I know for Altman Z does not do an Altman Z for banks because the factors just don't make sense. I do believe Bloomberg does do a that was a factor for default. For banks, we're going to probably bring in their tier one capital. That's going to be our solvency there. You want that higher or lower? What do banks advertise when you walk in the Frost Bank? Are they advertising, wow, we're 16% or wow, we're 3%? Which would you rather have? So higher is better. And so, you know, they want to be up there, up high. For insurance companies, we'd probably want their risk-based capital, but we may not be able to get that number. We might, most insurance companies and most bigger banks do have credit ratings. If we can't get a good Bloomberg, we can get credit ratings. What I've done with credit ratings, because they're not numbers, I'll take the credit rating and I'll look at historical default rates and I'll essentially assign the default rate to the credit rating. So if the 10-year default of AAA's is 0.8%, I'll put 0.8% for AAA and hold down the line. That's pretty easy to do. So you can convert credit ratings letters into numbers if you want to, but solvency, and then so there's a lot of industry specific there. Turnover is going to be tough. Wow, that's not how you spell turnover, is it? That's almost Trump over. So turnover, that's revenue growth. But we don't think about revenue growth like with the bank. Yeah, the revenues go up and interest rates go up, but that's not really good. So it's gonna be a little tough. We're talking about Valero, their revenue maybe get up just because gasoline prices are up, but so is their cost of goods sold. So we might look more at gross margin. So we'll have to do that. This is going to be industry specific as well. We can't really, almost none of our industries, except for maybe healthcare, and we just look at revenue growth because there's so many other factors going on. So yeah, materials are metals, revenue's up. Yeah, because copper prices are up, gold prices are up. It's like, that's kind of easy and it's going to fall right back down. Very, very different. So we'll have to be careful on that. Um, with banks, I'm not really even sure what we'll do. With banks, more than looking at revenue growth, we're probably gonna be looking at the source of revenue, especially breaking it between the interest side versus the other side versus the trading side, and kind of breaking that up. But it'd be interesting to see. Property and casualty, you can look at revenue growth. That one's not quite so bad because it kind of fits in that mode. You can't really do that with life insurance. Margins, will be industry specific here. We talked about the net interest margin for banks. That would definitely come into play there, but it will have some industry specific. Specific. Return on capital works pretty well for most entities. We'll probably use return on invested capital more than return on equity. Return on invested capital is real similar to return on assets. Banks like to use return on assets. Insurance companies use return on assets. So that one we probably can use return on invested capital pretty well. So why am I giving you all of this? When you're doing all of this stuff up here, be looking for specific ratios that define what's going on. So like with the bank, we talked about the net interest margin. We also talk about the efficiency ratio. Yeah, those are two for banks we'll definitely bring in. The net interest margin. That's an easy one to bring in. We can look at it over time and just see what's going on. Do banks like rising rates or falling rates? The answer is no, that's not their business. Their business is the shape of the yield curve. What kind of yield curve do they like? Steep or flat or inverted? When you loan out long and borrow short, what do you like? Like steep yield curves, don't you? Kind of nice. I have a 5-year auto loan at 6% and your savings account, you're paying 0.1%. That's kind of a nice spread, isn't it? 500 basis points. So banks like steep yield curves. Life insurance companies, what do they like? They like yield curves that never change. They're always the same. It was amazing at USAA. We ran a bunch of stochastic models and we're talking about hedging our life insurance company and hedging our bank. And after I ran all the models, I discovered we don't need to hedge them because they hedge each other. When one's doing great, the other's doing horribly. And it was pretty amazing. Life insurance companies don't like rates rising or falling. They like them just to stay the same. Banks love rates where they can lock in the longer rate and the short rate is falling, increases their spread. And plus they securitize a lot. So as you're reading this, start looking for specific things. There's a few net interest margins, efficient ratio. For insurance, it's for property and casualty insurance, it's loss ratios, expense ratio. So there's specific ratios. Just try to get them in the right category because when I run the model, I like to start with turnover, go to margin, handle solvency, which I put the liquidity stuff in there. I usually put the working capital in with turnover because there's a high correlation between working capital and turnover. So if you have good inventory turn, you're going to also have good asset turnover. If you have a good receivable turnover, you'll have good asset turnover. So start thinking through these ratios, maybe as a team, kind of each one of y'all pick a different big player in the industry to do an extra deep dive so you can come back with some good ratios so we can build the models on Tuesday. You're ready to go. Any questions on this? Let me show you a model so you can see kind of where we're going. So I built this model today. It took me 25 minutes to build it. It's not a very good model, but it's a new approach. I like this approach. We've done it in the past. I think it works really, really well. So I've got some companies here. This is all the materials companies. It's not, I didn't break it up into subgroups. It's just all material companies. There's 90 of them or so, or 85 or some, 87 of them. Well, I deleted a few that just didn't have good data. So there's the companies. Have y'all heard of these companies? Say stop when you see one you.
Sounds fun. Haven't been.
There's Royal Gold, Freeport. There's a few big ones, but there aren't that many really, really big ones. Probably we need to look, and this is something else, let me mention this. Let's put this on the list because y'all need to be thinking this. One other thing is look for major non-US players. Maybe go out and do a search on that so we just know who that list is, so we can bring those in. I think on the metals, that could be important. There's probably some big players. Energy companies, definitely. We want to bring in British Petroleum and a few of the others. All right, so how did I build this model? So if you think about this model, the way it looks at high level is I have a list of tickers in the industry, and then I have my factors. And my factors, I start off with turnover. Now with turnover, what we'll do is we'll bring in some of the obvious ones if they work, like revenue growth over the last 3 years, actual asset turnover. There are some times I love to do change over time. Y'all saw that last semester where I take this year's asset turnover versus 3 years ago, and I'm looking for firms that they improve their asset turnover. You can also do volatility. You have to bring in a lot more data, but you could bring in 5 years of earnings and see how volatile that earnings is. Bloomberg does do some of that. Well, they'll bring in volatility of earnings last 5 years. So we have to see what Bloomberg has. So the way I build the model is each one of these factors I'm going to rank. So if I do turnover and then I'm going to do change in turnover, to do change in turnover, I need 2 years of turnovers. I need 3 years ago and today. So what I'll do way off on the outside is I'll have other data where I might have turnover this year versus 3 years ago. So that only thing I have over here are my factors. So my change in turnover, I'm going to go over there and compare those 2 years and put that change here. All right. Everybody following that? We want to make sure everything we're going to rank is right in order all the way across. This is where the working capital stuff comes in. May not work with this semester because we're not doing retail stocks, but anything on working capital we can bring in. We saw that with Green Brick today, right, Robert? What they call working capital, I wouldn't consider working capital, but it really distorts the numbers. So Robert's got to make a decision, and his team, how are they going to define free cash flow for a firm where something goes through inventory that's really bizarre? But working capital. So those are my turnover. And then I'm going to do margins. I'm going to do gross margin. I do gross margin, which may or may not apply to your maybe an EBITDA margin. Remember, banks don't have an EBITDA because interest is part of their operations, so you can't do it. So some of these we can't do. We have to figure out. You might do a net income margin. You might do a change in margin. Again, we might put margins off on the right 3 years ago and today. We might do the standard deviation margin. Anything that gives us some indication. So we'll do something on margin. Then we'll do return on invested capital. What's happening here? How can the numlock not be on in a college of business? That makes no sense. Right? College of business, numlock should always be on. All right, so turnovers, margin factors, return on capital. Return on invested capital is one. I love EVA. I'm a big fan of EVA. You are stuck with Bloomberg's definition. We can do the change in EVA. So we'll put over on the right, their EVA today versus 3 years ago. You may remember the definition of EVA. Well, first, what does it stand for? Economic value added. And what do you compare? Two numbers you compare? Return on invested capital and WACC, cost of capital. Is higher better or lower better? Higher better. USA, our EVA target was 2%. return on capital versus cost of capital. You are stuck with Bloomberg defining return on capital and Bloomberg defining cost of capital. But the CFO of Rackspace, he came and spoke here before they got taken over, but he said they love EVA, not because it's perfect. You can find all kinds of problems with it. But if you're consistent over time, the change in EVA tells you a lot. Any given year, you can debate how it's defined, but as long as you're consistent over time, how it changes should tell you a lot. And it probably is the number one factor in defining how stock prices move. If you see a stock's EVA increasing, their stock price is increasing as well. So I love firms who have increasing EVAs. So that's a good section. There may be others there, obviously. For banks, we probably won't use ROIC. We'll probably do ROA, return on assets. When you do invested capital for a bank, it gets really tricky. Same thing with life insurance, because with banks, the deposits really is part of their capital. But if return on invested capital only looks at the debt, you're leaving a big chunk of their business out. So return on assets gives you a much better answer. And then you're going to do risk, solvency. Here, I like to use the Bloomberg default probability. I used 5 years. You can do debt to EBITDA, but that makes no sense for a bank. So that won't work for banks. That will work for energy, materials. Will work for some of the other industries. It'll work that those doing healthcare services, and healthcare equipment, especially healthcare equipment. Our models we used last semester work pretty well for healthcare equipment. It's not a huge difference. We can use ratings, but we'll have to convert them. So usually when I use ratings, I have a conversion table. You got to be careful with ratings because there's a lot of firms that don't have ratings. So you can get a lot of NAs when you do that. But if we're going to break up banks between big banks and small banks, the big banks almost all have credit ratings. Most life insurance companies have credit ratings. So that can certainly work well. So there's risk. So that's am I leaving out a category? What else could you do? I threw working capital in with turnover. So we got turnover, margins, return on capital, risk. Any other major area? We got to do valuation, but I mean, as far as a good company. So what's a good company? Good revenue growth, good turnover. What's the difference between turnover and revenue growth? So Walmart, wow, 8% revenue growth. That's great. They added 20% more square feet. Okay, maybe not so good. All right, so turnover is your revenue growth relative to what you had to do to get that revenue growth. You could say a firm that has turnover revenue growth of 3%, that's not too good, but if they shut down 20% of their stores, that might be pretty good. They got rid of the most efficient stores. So good turnover. So I want a firm with good revenue growth to have a turnover that's strong versus the industry and is improving, or like a Costco, it's number one in the industry and it's always been number one and it's not getting worse. It's hard to say the one like Costco who's in the stratosphere that you want them to get better. But if they're number one, just stay up there, that'd be good. But that's my definition. Good management of working capital. On margins, obviously I want competitive margins versus the industry that are improving or at least staying stable if they're strong. I want good gross margins, good EBITDA margins. Return on capital, I want good return on capital that's competitive with the industry. A positive EVA, trusting Bloomberg to calculate the numbers well. I love improvement in EVA, even though when you run the model, you don't see that being highly valued by the stock market. But I love that. I want firms with low probability of default. Reasonable debt. Now on debt, if you look at utilities, their debt levels look really, really, really high. But we're comparing utilities to utilities. Utilities have a lot of debt. That's the nature of the business, but it's perfectly fine. They usually have high credit ratings. So we'll be comparing them against each other. But if you were to look at a utilities debt versus a tech company's debt, utilities is going to look like, man, they're really overladen with debt, but we're staying within the industry. Most utilities are going to have credit ratings. So if we don't like the probability of default, we might bring in the credit ratings and use some type of table. All right. So that's our definition of a good company. So we're going to start with that. So that's what you'll work on this weekend. How would you define in those categories, turnover, margin, return on capital, and risk? How would you define those key factors for your industry so we can build a model? Be ready to come in on Tuesday with those type of ideas. We're going to take a good company and then talk about them versus valuation. We're using relative valuation. So what are we going to use? For financials, what do we use? Always. This is the only factor I've ever used. What's your relative value for insurance companies and banks? Price to book, always. Banks and insurance companies are probably the closest gap to reality of any entities out there. GAAP actually does a fairly decent job of valuing the firm what it's really worth. That's why it was so strange in 2008 when banks price to books dropped down to like 0.2, 0.3. That was my entire career up until 2008. Price to book for banks were like 1.5 to 2, pretty normal. And then in 2008, they dropped just dramatically. So JP Morgan's price book has come back pretty strong. It's at 238. It's a little high, so above 2 is certainly a little rich, a little high, but you say, well, is that high or that low? Well, how do you spell Palantir? What is Palantir's price to book? Anybody know? Does that look a little higher than a bank? 50 something? So, but what about Citibank? Anybody want to guess what Citibank's price to book is? Citigroup? Above 1 or below 1? What do you think?
0.7.
Finally got above 1. You're right, they were 0.7, but they finally got back above 1. They're one of the late arrivers to get back up there. You might have done an analysis of banks and said, man, Citibank looks awfully cheap, and they do versus the others, but they have some serious problems. We actually hear people talk about Citibank going insolvent in 2008. We weren't saying that about JP Morgan. What about Frost? Is Frost more expensive than JP Morgan or less? What do y'all think? What was JP Morgan? 2.4? Frost is a little bit cheaper than JP Morgan, a lot more expensive than Citibank. Would you rather own Frost or Citibank? Citibank, you get a 50% discount to Frost. You might say, yeah, but that's price to book. But remember, for the accounting for these banks, is much closer to economics than for any other entity out there. You look at tech stocks trading at 20, 30, 40 price to book, the book value means nothing. For banks and insurance companies, it's pretty close. If we look at an insurance company, their price to book, again, just like banks, between 1.5 and 2 is pretty normal. I'm not saying buy Citibank. I'm just telling you that they look cheap versus the other. I don't know if I could find an expensive bank out there. I can't think of one that would be really expensive bank. I can't even think what bank. We can look at Goldman. I mean, you see how normal banks are right in that range, pretty solid. I think Citibank's price to book got down to like 0.1 during the financial crisis. Can you imagine you get to buy the bank for 10 cents on the dollar versus GAAP accounting, which GAAP accounting banks do fair value accounting? This isn't like some historical cost. They actually mark everything to market. So this is like you're buying the market value of Citibank at a 90% discount. So today it's at a 4% premium. So this is a little more expensive. What about EV, enterprise value of the revenue? Completely meaningless for an insurance company or a bank. What about Chubb? What does Chubb sell? Commercial insurance, property and casualty, again, between 1.5 and 2. Very straightforward. That's one of the advantages of financials. The price of book is going to be in that 1.5 to 2 range, maybe 2.5, but it's going to be, it's pretty odd. You can't say that with tech stock. If I throw out, what's the current price to book of NVIDIA, what is it? Or even price to earning. I mean, it's all over the place, right? You have really no idea. For banks, you're expecting something that in 1.5 to 2.5 range. Pretty straightforward. All right, so that one we got. Healthcare. What would you use for healthcare? What's your fallback if you're not sure? Yeah, EV to EBITDA. It's a good one to go to if you're not sure. I realize we're talking about health insurers. Health insurers are very different than life insurers, and health insurers are more like property and casualty insurers. You could use price to book, but the problem is they're all mixed together now, and the health business itself, EV to EBITDA, can work pretty well. We'll have to test it. What we'll do with healthcare is we'll throw them all in there and just see if there's one that has a higher correlation than the others. So we'll probably try all 3 of them. EV to EBITDA, price to book, EV to sales. Remember, it's EV to sales and not price to sales. Don't use price to sales for any entity ever. Any questions? Jacob, Reed, Andrew, Christian, Gerardo, any suggestions on which to use? What we find is we think EV to EBITDA makes the most sense, but the model oftentimes will go to EV to sales, and sales works okay with healthcare. All right, materials, what would you think? Any guesses there? Remember what we said last semester? We have an entity that's very sensitive to commodity prices, chemicals, metals. How do you smooth out those cycles over time? Which ratio does the best on that? Well, EV to EBITDA is going to be this 1 year, right? So it's going to be somewhat fluctuating. Which one has several years of earnings in it? Book value, right? What is book value? It's retained earnings. What is retained earnings? Many, many years of earnings. So we typically use price to book, but we'll try some of the others. Rashid and Pepe with other like paper plants and those kind of things, you can use an EV to EBITDA for them. They're not quite as commodity sensitive. And there are some chemical companies that look more like industrial companies. The chemical they're selling is not actually a big part of their cost of goods sold, so they look more like normal entities. So we'll try price to book. We'll see. Okay, utilities, energy, there's kind of an obvious one here. Any guesses? Heavy property, plant, and equipment. Commodity price sensitive. What does that sound like? Price to book. Price to book. Now, are energy companies as price to book predictable as banks? What do y'all think? Any feeling on that one? So that one looks pretty good. Chevron, never knew where the X came from. Looks pretty good. How do you spell, what is Conoco? Cop, or how could I forget that? Oh, that's right, it used to be Phillips. So yeah, energy companies are a little bit on the predictable side there. What about utilities? Do you think they're that predictable? We'll try Duke. Yeah, you see with the price to book ones, when you have a lot of property, plant, and equipment, the price to book, you get something that's pretty close to the accounting value. I noticed this is 85% rich, right? Or 84% rich, but Palantir was 50,000% rich. So, it's a lot closer. So the entities that use price to book, you can usually tell because it will be in that 1.5 to 2.5 range. Generally. So it's a little more predictable than other industries like NVIDIA, just as an example, price to book of 37. It's like, who cares what the accounting value is? Just ignore it. All right. So if you think you're going to use price to book, well, let's do a materials company. So let's do NEM, New Mount. And you're thinking about price to book. You can see there it doesn't quite fit as well. It's a lot more expensive. That's one way to tell. If you're going to use price to book and you look it up and it's like 17 or 12 or 11, you think, okay, price to book probably has no meaning. It's not horrible here. It's not like 37.40 like we saw with tech stocks, but it's kind of high. Freeport. A little higher. So that's why I say on materials, it can work, but we start getting further and further away from book value, from the accounting value. So price to book is nothing more than the market cap of the firm to the net worth of the firm on a GAAP basis. And in some firms, like McDonald's, what's McDonald's price to book? Why does McDonald's not have a price to book? That should be pretty straightforward, right? Why does anybody have any idea why McDonald's doesn't have a price to book? You don't have a price to book, that probably means you don't have a what? You don't have a book value. McDonald's is bankrupt. You don't know that? From an accounting standpoint, McDonald's is bankrupt. Why are they bankrupt? Because they bought so much of their stock back that they have no net worth. And there's about 6 or 7 very well-known restaurants that have negative net worth, so you can't use price. We wouldn't use price to book for McDonald's. You probably use EV to sales, but for some entities, you can't because they have no book value. All right. We kind of saw the same thing with industrials. Price to book works pretty well for industrials because they have a lot of property, plant, and equipment, but you can kind of tell by just looking at the firm to see, like if we put UPS in there, which I don't really think as an industrials or transportation. You're starting to get much further away by accounting values. So use that as a rule. Look at the price to book if you're going to use it. If it's in that 1.5 to 2.5 range, you're probably good to use price to book. All right. So that's my valuation. So pick the correct one. So I use price to book in this example I built. Then what we're going to do is we're going to rank. So the model I'm going to build this time, I want y'all to look at this, see what you think of it. I'm not going to force you to use it, but I really like this model. So this is really simplistic. I built it really fast, so 25 minutes or less. I think probably even less than 25 minutes. And I brought in all the data for turnover. Here's the data for turnover for all these companies. And then I calculated the 5 percentile, the 95th percentile, and the median. 5% of companies, their turnover was 2.23 or lower. 95%, their turnover was 1.68 or lower, or 5% is 1.68 or higher, and the median was 0.75. And I did that all the way across. Now I could change this. Instead of that, I could have done the 10th and the 90th, but I decided to do. Did any of y'all use this model before? We used this a few years ago. I think this is all pre-COVID. I don't know, Reed, did we do this model with you? So I like this model. I think it. So remember last semester we used a ranking model. So you had 40 companies, you ranked them 1, 2, 3, 4, all the way to 40. The problem with that is you get a number, and the weighted ranking number comes out at 26. You're like, okay, 26, but how many companies are there? You don't know what the 26 means unless you know how many companies there are. All right, so I'm going to show you here the number you get out of this model means something the second you see it. All right, so I know the range, I know what the norm is, I know the range, and so when I rank them, what I do on the ranking, so it's kind of bizarre. What I'm doing the ranking is, first of all, if they're above the 95th percent, I give them a +1. If they're below the 5%, I give them a -1. So we're going to rank everybody between -1 and 1. And what we're going to do between -1 and 1, we're going to talk how close are they to the median. They're right on the median. What do you think they would get? You rank from 1 to -1. What's the median going to get? 0. So if someone gets a score of 0, what does it mean? They're right with the median. All right. And then I compare how far are they from the median to the 95th percentile. So if they get a score of 0.98, what does that mean? Pretty close to that 98th percentile. If they get a score of -0.98, what are they? Pretty close to that -0.98. All right. If they get a score of 0.03, what does that mean? Slightly above the median. Get a score of -0.26. What does that mean? Somewhere between the median and the bottom 5%, right in the middle. Right? Understand that? Okay, so how does this firm do on turnover? -0.87. Anybody explain that in terms and words? First of all, is that good or bad? You want turnover to be high or low?
Higher.
Higher. -0.87, is that one of the best companies or one of the worst companies? One of the worst, pretty close to the bottom 5%. Okay. What about this firm? They're at the 0.95% or higher. Now, why do I use 0.95 and 5? Because if I have a firm that, let's say the median is 0.75 and they come in at 63.4, then what's going to happen is they're going to be number 1, and then everybody else is going to be right next to the median because they're so far away. So by doing that 95, I kick those extreme outliers out so that I don't distort my numbers. All right. That's the reason we do that. So 1 just means they're at the top, they're in the top 5%. I'm not going to give them any more points than that. What about 0.52? Is that good or bad? First of all,
Pretty good.
pretty good. Where did they score between the median and the best? Kind of right in the middle, right? So you almost could say they're kind of in the top 25%. 0 is right at 50th, 0.5 is in the top 25%, -0.5 is the bottom 25%. You see how that works? I do that with every factor. The one exception is on the default, where I do it the exact opposite. So the higher probability of default is going to give them a negative number. The lower probability is going to give them a higher number. So I have to flip that one around. And then I rank them. I do a sum product with my ranks. I did this 2 ways. My first approach was what I desired the weightings to be. I wanted 10% in turnover, 15% in sales growth, 10% in gross margin, 25% in net margin, 20% return on invested capital, and 20% on risk. And then I also ran solver to give me the highest correlation to my evaluations. And I just kept it. Remember last semester we erred toward the solver. This time I'm going to say forget solver. What do we think is important? We're going to try that as our approach, because I think we should say what do we think is important. So based on that, here's my ranking. But then I re-ranked my ranking based on the ranking so that I would have firms ranked. There's my best firm right there, number 1. There's my worst firm, -1. How does that firm do there? 0.4. Is that high quality, low quality? And what percentile is it in? Top quartile, second, third, or fourth? So top quartile would be what? 0.5 or higher. So what is this firm? Kind of the top end of the second quartile. Right, you see that? Pretty strong. How's that firm? How about that firm right there? Pretty strong. That firm, great, decent. What about that firm? -0.7. Far down there. That's on the good stock. So is this a good stock? No. What does the stock market think about it? Here's valuation. Well, it's the cheapest, one of the cheapest ones out there. I don't want a bad company that's really cheap. I'm okay with a decent company that's really cheap or a great company that's cheap. I don't like horrible companies that are really cheap. Just doesn't appeal to me. Here's a horrible company that's really cheap. Here's a decent company that's kind of cheap. Not real great, but okay. Here's a great company, but a little expensive. This first one up here is a good company that's really cheap. What's your first question you ask is, what did we do wrong? That's what we ask first. There's got to be something we're missing on this company. But for right now, we have it. Now, do we just put this on our buy list and go with it? What's one thing we know we're going to kick them out? What's the thing we say we have to kick them out if they do what? They have what?
Below $1 billion.
Below $1 billion market cap. So we need to bring market cap in there so we don't waste time on smaller companies. But we need to look at that. So I'll look at the difference. Higher difference is good. So this one, we ranked at positive 0.4. You all see the advantage of this over the old ranking. You can in a second look at the number and you know, okay, this is a second quartile firm that's in the bottom quartile on valuation. That sounds pretty good to me. The second one is a second quartile firm that's also in the bottom quartile of valuation. That sounds really good. Again. Here at the bottom, we have the worst company out there, and it's one of the most expensive. Anybody want to buy that company? What does that company do? Why does the stock market like this company? Ivanhoe. How can you not like Ivanhoe? Electric Inc. Why is Ivanhoe Electric Inc. in the materials? That sounds like it should be where? Maybe it should be a utility. I don't know why it's there, but anyway, it almost makes you want to go research it. Like, why do we hate it so much? Now, how can you figure out why we hate it? You can go back and look at the ratings and see where they rank, but they were worse there, best there, worse. Okay, hey, it's pretty bad company. Here's one that's one of the worst, and kind of above average valuation. Here's one that's pretty bad and it's really expensive. What would be our buy lists? So here we might take everything that's in a 0.5 or higher, maybe. Gives me 23 companies. Is that enough? We have 4 people in materials. That wouldn't be enough. But we could take all the ones that are top 20.25 or better. 39 companies. Is that enough? And we could just go down the list and pick enough so that you have enough to look at. Or we could stratify this between chemicals and metals and others as well. So one thing about this model is once we have it, this isn't a good model. It's too simplistic. We can copy it, paste it on another sheet, and take out everything but the metals and rerun it and see how it goes. Take out everything but the chemicals and rerun it.
So these are companies under the 1 billion market cap?
I haven't looked to see their market cap, so there could be some under, but there probably are some because of this. Right. So for utilities, we'll probably do exactly this. We'll run them all together, and then we'll try some stratifying. What if we just bring out the electric companies, the water companies by themselves? So we do the water companies, there's only 4 of them. Okay, we can't really do that. That's not going to work. With banks, what I like to do is let's run them all together, and then let's separate them by market cap. The companies that, the banks that are over 20 billion market cap, we're going to separate them out from all the small companies and look at them separately. And you will get a much better model when you separate them out. You don't really want to look at a Frost Bank with a JP Morgan. You want to separate them out a little bit. But I like bringing them all together first and then start stratifying to see if you can get a little bit tighter model as you bring them in. So pretty straightforward. The chart doesn't look so hot because the R squared is not so hot. The R squared is only about 16%. But part of that's because I do have the outliers in there. But you can see there is a relationship there. If you took the outliers out, the R squared would probably jump up quite a bit. Here's the best companies down here because good company is along the x-axis. So you want to be as far east as you can get. Those are the good companies. West are the bad companies. And then valuation is on the y-axis. So the cheap companies are down here. That 0.4 minus that 0.4 minus 1, that best company is right here. So the absolute best be here. We rank it number 1, and it's the cheapest company out there. That's kind of the company we saw over here. We ranked it -1, and it's the 0.88 more expensive. That's the company you want to flee. So we're looking for our buy list companies in this category down here. And we can look at the difference as well between our rank and the rank of the valuation, and you can get a buy list pretty quickly by looking at the difference. There are ways you could stratify this. And we're almost out of time, but you remember how we did our buy lists? Anybody remember how we do that? You remember we did this? So here it makes it a lot easier. Remember when we did it, we say we want them ranked in the top 25. Here we just say we want them above 0. All right, we want above average firms. And how much of a difference do we want? Maybe we want it to be 0.25. So we'll say, hey, if the firm's rank is greater than or equal to 0, which means in their top 50%, and if the difference is greater than or equal 0.25, buy, otherwise nothing. Let's see how many buys we get. Did I not lock it in? So we got some buys. Let's change it a little bit. So 24, how many are, there's 4 of you in Carol's? Maybe 6 each, not quite enough yet. I could get this higher. You can make it 0.1. Yeah, you can make those adjustments to see how you get your list to where you want. We could stop there and just assign out the stocks. You know you can get some bad companies if you do this, but we're just trying to get a list of firms that meet our criteria, have these characteristics, we really like them, and then divvy up the list in some way. But you see where we're going next week. So this took me 25 minutes. How long is it going to take us next week? My guess is an hour to an hour and a half per team. I want to do these by teams. Now, utilities and energy, we're going to have to split it up between utilities and energy. So on Tuesday, we need to have y'all somewhat. So really what I'm hoping on Tuesday is we can build a model in the class on Tuesday as much as we can and try to finish it up. And no, not try to. We will finish it by Thursday. All right. So what I want to do, y'all see where we're going on Tuesday. Everybody see this? How are you going to help me on this on Tuesday? It's these categories. How are we going to find a good company? Okay, so do some research on that. Look at what kind of ratios they look at. Read about that. Help me with that. Do y'all like this model better than last semester, or is it about the same? Can y'all tell a difference, or you got to get used to it a little bit? Better. I mean, I've already got it built, so you don't have to build all the junk. All we got to do is build this part. Once you get this part over here built, you just copy the rest of it over and go forward. So we've used this before. I like it. It just once you get used to it, you see a 0.23 and you immediately know what it means. It's just much faster. Remember last semester we saw a 27 and go, wait, how many stocks are there? Oh, there's 56. Well, 27 is not all that strong. But here you know a 0.24 exactly what it means.
On the screen model per sector, or like financial stocks too?
Well, what I'd like to do, we won't do financials, we will do banks. What I like to do is do all the banks together, take that model, copy it to the next sheet, and delete certain segments that we don't want. So we'll do all materials together, copy it over, take out all the metals and other, and just do chemicals. So that's the way I'd like to do it. The nice thing is once you get the model built, stratifying becomes really easy. You just copy it and delete, which means what we need to do over here is bring in those subsectors, sub-industries, so we can easily stratify and break them out into different pieces. So utilities, we'll just bring all the utilities and all the banks. So on Tuesday, get organized, walk into the FSC on Tuesday, try to get a little bit early, find a Bloomberg machine that's working, sit down. You might even get a head start and go, y'all know how to do it, right? Bring all the stocks in from your sector. Y'all know how to do that. Get it into Excel, get it set up, get it ready to go. I'll get this template. I'll put it out there on Canvas so that you can see it. And so any questions on this? Some of y'all have kind of the deer in the headlight look. But, stuff when you see it for the first time, it's a little nerve-wracking. Those that were here last semester, it's not too bad. So I'll put that out there. The other thing I will put out there is this presentation we showed last semester, which is on porters and economic moats and Helmers and value chain management. So you can see if you want to look through that to get some ideas on how to look at a company. So, all right, any questions on where we're going? This is a tough class. That's why we only pick best students, but we got to get rolling so we don't get behind in the semester.
How do we kind of stop ourselves from breaking the sector to too many industries and running too many models and just kind of?
Well, it depends every single time. I think as we run the model, we saw that last semester. You run the model, say it's not going to work like this. We need more stocks. Now I knew, like with Auburn, I knew airlines would work by themselves because we've done it before and it worked pretty well. But sometimes it doesn't. Consumer staples, discretionary. That's like, we really need to pull out the autos that really messes things up or whatever. So it just depends. We're dealing with sectors I'm not as familiar with. They're not my sectors. Financials I can handle really, really well. But some of these other sectors we'll just have to learn as we go. So, all right. Any other questions on here? Don't forget, look for international stocks. That's going to be important. Make sure we get those on the list because we want those on the list next week. We don't want them to throw them in 2 or 3 weeks later. So, all right, I'll put this out there on Canvas.